Hello traders, and welcome to the first video within the fourth section of the IPDAtrader's private mentorship course. And guys, this entire section is going to be dedicated to confirmations. You're going to learn everything you need to know about confirmations, and this really should be at this point a missing piece for you to create your own system that you can potentially denote with rules and execute on backtest. And once you've done the backtest, you have a system that you know you can follow and potentially profit out of the market, right? So let's do a quick summary of what we have at this point, right? You understand structure very well with the structure section, right? You understand that, hey, once I have something like this, I can potentially be expecting returns over here, and this is going to sort of give you a bias, right? So you understand structure, you understand points of interest, which are essentially those rectangles you see in this chart. Once again, you have particular areas you want to watch in order to potentially execute positions, right? We got a point of interest over here, one over here, one over here, and one over here in this case, right? So you understand that, and you also know about liquidity, which is going to function as a sort of confluence for your point of interest, right? It's going to help you, for example, saying to yourself, okay, I may just want to be waiting for this point of interest because we may have some liquidity being engineered over here, and I feel like that's going to get taken into my point of interest. And then once price is here, is when I'm going to be watching for confirmations to then execute positions lower, which I'm going to be managing along the way, targeting potentially liquidity lows or opposing demand zones on the way down, right? That's going to be completely up to you, but let's now focus on confirmations. So let's actually go to the drawing board and let's get started with confirmations. I'm going to be sort of explaining why we look for confirmations, what they mean, and what we use them for, right? Because really, if you wanted, you could use risk entries, right? If you were, you could potentially do something like this where you place a sell limit over here, you put your stop loss above the point of interest, and you expect price to hit it and continue lower. However, that's considered a risk entry, and this is where confirmations actually come in handy. So let's get started with confirmations, guys. So guys, here we are in the drawing board, and let's actually get started. As we said, we're going to be discussing, let me actually grab a bigger size over here, confirmations. Just like this, confirmations. So let's actually get started with what is a confirmation, right? So let's draw a scenario. Let's say we had the market pushing down, we had a break in market structure and price is retracing, and now we are at your point of interest over here, right? So this is where confirmation comes into play, right? And what you essentially want to do is follow a particular rule over here that I'm going to be giving you, and that rule is the following. You want to be watching price 30 time frames lower in relation to your point of interest. That means, guys, that if this was to be a 30-minute time frame, right? Let's imagine this is a 30-minute time frame structure and this is your 30-minute point of interest. You want to be watching a 1-minute time frame once price hits your point of interest. Okay, this is pretty important. You want to be watching price at least 30 time frames lower in relation to your point of interest, which means if this was a 1-hour time frame, you would be watching a 2-minute chart once price hits your point of interest, right? If this was a 2-hour time frame, you would be watching a 4-minute chart in order to try and find and spot your confirmation, right? So we understand that now, right? That is a rule that you want to write down for yourself. You really want to be watching price 30 time frames lower once we hit our point of interest. And what you're going to be doing at this area is looking for some sort of confirmation that is then going to allow you to execute finally your positions, right? So let's say price comes into a point of interest and it does something that you like, right? Do not worry, we're going to be learning about confirmations in a second, but I need to get your mind straight first, right? So we understand that, hey, we are at a point of interest. I need to be watching price. Maybe this is a 1-hour chart and I'm zooming into the 2-minute time frame, and this is what I'm seeing on the 2-minute, right? So what you're essentially going to be waiting, just as a rule of thumb, is some sort of break in market structure, return, creation of higher low, creation of higher high, which means another break, and this is then going to be your execution point over here. And do not worry, I will get into details, but for now I'm just giving you an idea of a confirmation, right? And this is where you say to yourself that, hey, if price comes into this point of interest that was left behind within my higher time frame point of interest, that is actually sort of showing me a bullish structure in this case, with bullish liquidity to grab above, potentially trend line over here, or relative equal highs over here, right? This is going to be where I'm going to be happy to take buy positions in this case. So let's imagine price comes down again, you get your entry, and price starts moving higher. So this has been your confirmation process, right? You waited for price to hit your point of interest. This is important, guys. You waited for price to hit your point of interest. You waited for price to show you whatever it wanted to show you within your point of interest, and you decided that, hey, I am now happy in taking a position over here since we successfully confirmed this point of interest, right? This is crucial. And really, just to make this very clear, having a confirmation within your point of interest is not always going to be a guarantee winning trade. You need to understand that we're still playing with probability. Yes, we're being very precise and very picky in regards to where we are executing, but that doesn't guarantee a 100% win rate whatsoever, right? It just means that now once this fractal occurs, this now means that the probability of price actually going higher and starting to clear liquidity to the upside is very likely, right? Especially if you have done a great job in regards to structure, liquidity, and point of interest, right? If you have all the three elements correct, and this is important, if your structure is correct, meaning you're reading structure the right way within the time frame that you choose to work with, and you have your point of interest correct and your liquidity correct, then your confirmation is really going to be correct most of the times, right? However, there is always still a probability it's going to fail, right? And you will see that happen. It's going to fail, and it will hit a lower point of interest potentially, and then it would potentially shift very aggressively, and you're left out without an entry, even though you did your work correctly, right? This is why understanding the probability nature of the market is crucial to your psychology and keeping your psychology intact, right, at all times. So with all that explanation out of the way, we're actually going to be diving into different methods that you can use to confirm your point of interest, and we're going to be doing that very slowly and potentially taking a look into the charts so that you can see them in action. But one thing I want to make very clear at this point is that each and every single mitigation play, right? Meaning that once price is in your point of interest, you are always going to be having some variables and some sort of it's not going, there's no two equal mitigation plays, right? It's always going to be a little bit different, and that's why I'm going to be giving you some rules that you can apply to multiple situations. You will never have two exact same mitigation plays, right? That is very unlikely that you see, for example, a perfect double top creation, sweep, and drop, right? This is going to happen, yes, but the way that the next POI mitigation is going to look like, it's probably going to be very different. That's why you need to have multiple ways to confirm your point of interest, and you sort of need to have some rules that say, hey, this is a valid mitigation and shift, or no, this is not a valid mitigation and shift, even though it may still work out, right? Perfectly fine. But you need to understand that you need to define some rules for yourself that you can easily and happily follow without the need of getting FOMO or saying to yourself that I'm waiting too much, it's going to drop now. No, you need to be very patient with your confirmations, and you need to give sort of price some time to develop within your point of interest. You want to read the information that is happening over here, right? So with that out of the way, now we're really going to be taking a look into actual confirmation protocols that I'm going to be giving you here. And it's your sort of job to backtest those, see what resonates with you, and stick to that. So the first entry protocol that you're going to learn at this point, let me actually get rid of this, is known and is called the external plus internal shift. And this is actually a reference to structure because you're going to be tracking structure on a lower time frame within this protocol right here, right? So let's do the example. Let's say we have market over here, push up, and we're now in a point of interest. Okay, great. What do you want to see in your point of interest? Let's actually do sort of steps down because it's going to be much easier to understand. Okay, price is now in my point of interest. What do I look for? What do I do, right? So here's where external and internal shift comes into play. If this is the structure, right, and remember, guys, you need to zoom into lower time frames. This is, for example, a 30-minute point of interest, and this is your 1-minute time frame coming down, right? Because as price is going to be trending down into your point of interest, right? Once price hits your point of interest, guys, the first thing you want to assess is the distance between the lows. And this is called compression. I talked about it in my YouTube channel, sort of not in too much detail, but we're going to be getting into detail now, right? So you want to be assessing how price is moving down, right? You want to be tracking order flow. So let's say that the distance between the lows have been decreasing, right? Meaning that we're getting compression, right? Something that could look potentially like this. We're slowly coming down, and we're indeed coming down, but we're getting compression, right? The distance between the lows have been decreasing. It's not like you're getting a down move of this nature right here, right? Where it's pretty aggressively. No, this actually shows you that the volume in selling the market is decreasing. However, we're still pushing down, so there's no execution just yet, right? So the first thing you want to assess is called compression over here, right? And if you have the element of compression, that is great. Again, it's not a sort of rule. It's just another tool for you. If you see compression, then you can assume that, hey, we may be shifting here. I want to be paying close attention for my confirmation, right? So let's remove this stuff and let's get into the confirmation. We hit our point of interest, and what you want to watch out for is for a external shift. If you understand structure, right, and you should understand that this is a external point, and we may potentially be now making an external point over here, right? And what I mean with an external shift is if this is your 2-minute time frame coming down, you want to wait for one of these highs to break in this case, because this is going to be a external shift. You want to be watching what move caused the low that is currently being made, and you want to look at that. And once you identify it, you can very well see in this case that the move that made the low is this high over here, so you want that to break first, and this is going to be known as your external shift, right? So let's imagine that price is now in my point of interest. Maybe we play around for a bit, right? Something like this. And you want to ask yourself, where did this low come from, right? And you don't want to be saying up here because this is the origin. You want to be actually looking at the internal leg. Okay, this is right here. So you would go ahead and label that. You say to yourself, this is my external shift point. And what you want to do is wait for price to actually first break that external shift, right? External point. Once that is broken, guys, you want to wait for at least a 50% retracement to consider a higher low being established and an internal shift, right? So this right here would be considered your external shift. And again, this is not a valid confirmation just yet, yeah, right? You need to wait for then price to retrace about 50% at least. The more it does, the better for you, to be honest, but at least 50%. Once you get that, you want to wait for an internal shift, right? And let me actually go back in time over here because I need to sort of redo it. So let's actually go ahead and say it again. This is your external shift. As we break, in this case, the high that caused the low in the lower time frame, where I'm watching price, right? This is important. Know the 30-minute, because if this is your 30-minute structure, you then would need to break above this high, and in this case you would have missed the move already, right? You want to be taking this higher over here. So you want to be assessing the lower time frame that you're watching and waiting for that external shift. Once you get that, you want that 50% retracement or more, and then you're going to wait for an internal shift, which is the break of any over here, right? Either this, or this. This is going to be considered your internal shift, meaning your internal structure is also shifting bullish at this point, right? Something like this. You then would, for example, wait for this high, this high, this high, this high. Doesn't really matter. That's up to you. But in my case, I would always want to see sort of the higher blocks being broken. And once I get that, just like this, let's imagine, right? We're following price. We have the external shift. We break that. We come back to a potential block over here. This is not your execution point right here. This is very risky because this could very well be a liquidity grab to continue lower, right? So you don't want to be doing that. You want to wait for your external shift, and then you're waiting for your internal. And this right here, guys, is the moment where you are now valid for executions, and you can label that, and I suggest you do so in the beginning at least. This is now your internal shift, and now you can assume that the interest is in clearing liquidity to the upside right here, right? So what you can do at this point, and this is where a little bit of subjectivity comes into play, right? If you see, for example, that you have a order block over here, maybe another one over here lower, right? If you candle, these are all valid points of interest. What you need to understand, guys, is that if you want to be safe in taking this position, you want to keep the your stop loss below the low. Whatever the low is that actually started this shift, you want to be putting your stop loss below that, right? You can enter here. That is absolutely up to you. Or you can be more risky and say to yourself, hey, I want a tighter stop loss so I can have a bigger risk to reward, and you can enter here, right? And this is also valid. Or you could potentially enter over here in this block, and this is also valid. That is completely up to you. Where you want to enter, nobody is going to give you sort of a rule to do that. You want to decide for yourself. You want to ask yourself, what is my comfort level? Am I happy with a 6 pip stop loss? Am I happy with an 8 pip stop loss? Or am I happy waiting for a potential 2 pip stop loss that is going to give me a higher RR? And that is completely independent and up to you, right? So this is the explanation of one of the entry protocols that you want to be sort of understanding. And this is called the external plus internal shift. You want to wait for that external shift first, which is the break of the high that made the low right here. Again, it's a little bit of subjectivity here as well, right? You could very well be using this high, but this is liquidity. So you can see we have some sort of triple top, so I wouldn't be considering that, right? Because it could very well be a liquidity grab and a move lower. So you want to wait for that. You want to assess compression. If you're getting compression, that's great. That's nice confluence to have. Again, not necessary, right? So you wait for that external shift. You then get that external shift, and you're now waiting for a retracement for of at least a 50%, so that you can say to yourself that, hey, we've retraced 50% or more now. If we go ahead and break the high again, this is considered a valid structure point, meaning higher low, and we would have made a new higher high. So now I'm valid for buy positions. And then you would actually look into your points of interest that were left behind. Probably you want to be prioritizing those who have no mitigation, as they're likely to be returned into, and you then execute your position higher with your stop loss always below the low. This is important. Stop loss always below the low. And this is an example of a external plus internal shift protocol within a bullish trade. And we're going to be doing the same thing now for a potential bearish trade, right? So let's actually do that. So we get rid of all this stuff, and let's actually do the same thing, external plus internal. for a bearish scenario, right? Just so that I can ensure you understand the protocol here, right? So let's say price is pushing up, potentially like this, right? And again, this is your 2-minute time frame, right? This could be very well a 1 hour point of interest over here, and this is your 2-minute time frame coming up and trading into your point of interest. Great. First thing you want to assess is look out for that external shift, right? So maybe price plays in and around over here for a little, and now we get our external shift over here, right? We can denote that. Again, we don't want to be executing here just yet because this could very well be a liquidity grab and we could continue lower. This is too early, definitely. So we break that, right? Let me actually use a line because it's going to be much easier to see over here. And we understand that this is our external shift. And now all you need to do is wait for that 50% or more retracement, right? And if you don't get it and price continues to melt, then you've probably missed the trade, unless then price comes back up and you can still assess for that internal shift maybe over here and continue taking trades lower. But if price doesn't return instantly, then that's it. You cannot do anything. You were waiting for your rules, and your rules are profitable, so you don't need to be mad. So you get your external shift, you wait for that retracement. Once again, let's imagine this is your 50% and we trade above it, right? We potentially mitigate a block over here, right? That doesn't really matter. And now we get our internal shift, which should be any block over here getting broken once again, right? I would much rather prefer those at the bottom, because we can very well break one of the first ones and continue higher. This is sort of going to give you much more confluence and confirmation, right? So then we retrace, we start to move down, and we trade below the low, meaning we have now our internal shift. We denote that internal shift. And now you can assume that, hey, my structure looks like this, right? Lower high, lower low, lower high, lower low. Now I can potentially expect a lower high into a new lower low. And this is where you execute. So let's actually see that. Now you have multiple points of interest that you can use to take trades. And this is completely up to you, once again, which one you want to use. So let's actually get rid of this because it's getting pretty messy. You get your internal shift. Whoops, let's keep the point of interest. You get your internal shift and now you're valid for sell positions. So you identify a potential FU candle over here with no mitigation. So you say to yourself, I want to take an entry once we're here, and this is where you could potentially place your sell limit, right? You're then going to wait for price to hit your sell limit. And once you're there, you remember to put your stop loss always above the high. Again, it could very well never trade above this and continue down, and that's going to be great, but you still want to keep your stop loss above the high because you don't know if there is another block over here that may want to see some mitigation before the actual move down, right? So you wait and you take your trade over here and you still keep your stop loss above the highs over here. And this is a excellent protocol that you can use. And once again, this doesn't mean that it's going to work 100% of the time, but it's going to sort of give you a nice way to really confirm your point of interest. And this is where you take your chance and you execute right here. And now this should be very clear at this point, right? You should understand that we look for an external plus an internal shift. You want both shifts to occur. Once again, the external shift occurs once, in this case, the higher low that made the higher high gets broken over here, right there, and then we retrace up to 50% or more, and we break once again. This would now be considered your internal shift, and now you're really valid to take sell positions. So with all that out of the way, let's actually go back to the charts and let's look for some examples, because really you want to be seeing that in candles so that you can use to that idea. Let's go back to the charts, and we're looking at BTC in this case. That's absolutely fine, but it's just to prove you that this idea works in every market, right? It's not only sort of reserved to forex. No, this is actually valid for any market that has manipulation. So let's actually just look for a point of interest Let's see, over here, we do have a point of interest over here, right? You could potentially have been waiting for this FU candle to hit to potentially look for moves up, right? Just like in this case, works perfectly. So once again, you want to be watching lower time frames. In this case, 30-minute time frame, 30-minute time frames lower would be the 1 minute. So you want to go there. Let's actually, hopefully I can go that far back for this mitigation play. I believe we should be able to see that. Let's see. Yes. So as you can see, we have our point of interest over here. Once again, you could use this region, this entire down move before the up move. It's individual. I would use something like this. And now let's see what we have. So price comes into our point of interest, right? At this point, we're not still in our point of interest. At this point, we really are in our point of interest, right? So let's see what happens over here. We want to ask ourselves the question, am I getting compression? And really, in this case, absolutely. You can see the distance between the lows. It's not really that much. We're sort of compressing down, right? It's not like over here where we're aggressively trending down, right? You can see the distance between the lows over here. One low here, the next one over here, another one over here, right? So you can clearly see that here we're getting compression, which is a pretty good sign. So we remove that. And the next thing you want to do is ask yourself, where is the up move that made the current low? And this is your lowest point. So you look up and this is what you see. You now can say to yourself that this is my external shift, and you label this. You do that, right? Let's actually grab this external shift right over here. Great. Now that I have, and let's actually denote the structure point so that is easier for you to see, because this was your previous lower high over here in this particular time frame, right? Whoops, this is the wrong tool. Just like that, external shift, right? At this point, once this high is made, we have an external shift right here. So now you're waiting for that retracement, right? And you want to grab your fib, place it at the bottom, drag it to the top. And as you can see, if we were to have hit the 50% and then make a new high, that's valid. That's valid for an internal shift, right? But the lower we go, the better for us, because that's deeper mitigations. That's actually more room for us to play with, right? If price would have not hit the 50%, let's say here, right? As you can see, we sort of retrace a little bit. If price would have made a new high over here, this would still be considered your external leg. Why? Because we're still not making that 50% retracement or more. You need that 50% or more retracement to consider a valid structure point. And this is explained in the structure section. So we do that, we follow price, we get a low over here, once again, well below the 50%, so absolutely valid. And all you're waiting for, right, you could potentially see this as an internal shift. This is subjective, but I will actually go ahead and most likely prefer the high to be broken again, right? So we understand that the moment we make this high, we want to look at the origin over here. So this is now our confirmed higher low over here, and we make a new high over here. And now we're absolutely valid to take buy positions, whether you want to sort of use APY over here, or you want to be using APY over here, or you want to use APY over here. It's completely up to you, okay? In this case, you should have, you would have needed to use any APY really sort of in this place, because price never really retraces that far down and moves higher. And this is going to happen, right? So you want to make sure that you are understanding the risk in waiting for those lower areas to get hit, right? Just like in this example over here. So we see that you could have potentially now said to yourself, hey, we have an external shift over here. We have an internal shift over here occurring. And now we are valid to look for buys and actually execute buy positions, right? So I think you could have done, I would have seen this FU over here, right? You could have dragged that across. You could have placed your buy limit over here, or you can execute manually. It doesn't really matter. But as I said, you always want to keep your stop loss below the low, even though price may have hit the block and continue higher. You don't know that. You don't know if price wants to retrace all the way down and maybe hit an area over here and then move higher. So always keep your stop loss below the low, and you can always target way higher because you're using higher time frames, and you should be able to get pretty clean and high moves. And this is actually a nice entry protocol that, once again, it's not always going to be perfectly fulfilled. It's not always going to work perfectly, but it's a sort of system that you can follow within your points of interest, confirmations to execute positions. This is going to serve you extremely well. And once again, I don't want to make this video too long because we got more stuff to talk about. So this is going to be it for the first video within the confirmation section. Remember to take notes, remember to study, and really try and understand this protocol over here, right? You can always use the community. You can always privately message me in Discord. I will have no problem in really talking to you and trying to see what your issue may be, right? So understand that, please. You're paying to be in the community, so you want to be exploiting your time in the community. Please, please, please. Now, with that being said, guys, I will see you guys in the next video, which is essentially going to still be talking about confirmations. So I will see you guys soon.